Hey guys, the purpose of this video is to give you an introductory lesson on depreciation and depreciation expense. So in accounting, depreciation is a term used to describe any method of matching the historical cost of a long-lived asset. So that's an asset that's something that's permanent or that has a long life. Like for example, if we purchase an automobile, it's probably going to last us more than just a couple of months. Except for land, we're never going to depreciate land because the land that the community college is built on now was the same land that was here when the Croatan Indians were around, which is the same land that was here when the dinosaurs were here. So the land is here, it's not going anywhere, and so it's not going to wear out the same way a building or an automobile or some other type of long-lived asset might. Okay, so it's a process of matching that historical cost against the revenue produced by that unit over its useful life. So if we purchased a piece of equipment, for example, and it's going to help us make dry erase markers. Let's say we make and sell dry erase markers. If it's going to help us produce that for 5 years, it doesn't make sense to expense that machine in the first year or in the last year. It makes sense to depreciate it over the life that it's going to work, right? Over its useful life, which is the time period that it's going to allow us to make goods to sell to generate revenue. So we're trying to match the expenses with those years that it's going to help us generate revenue. Alright, now later on in the course we're going to discuss some more depreciation methods in greater detail, but the purpose of this right now is just to kind of give you a brief understanding. And so when we are depreciating an asset, it is systematically allocating the cost of the depreciable asset from the balance sheet and reporting it as a depreciation expense on the income statement. So we're slowly taking it. Instead of expensing it all at one time, we're going to, for example, let's say we paid $25,000 for that machine that's going to allow us to make dry erase markers. Instead of expensing it all in year one, we're going to put it first on the books as an asset, and then we're slowly going to take a fifth of it every year and expense that via depreciation expense. Okay? So accounting does not attempt to measure the change in value of these assets each period, these fixed assets. Instead, a portion of their cost is simply allocated to each accounting period. So in the same example, that $25,000 piece of machinery that might help us make dry erase markers, we're not trying to figure out the fair value of it every year. We're not trying to figure out what we could sell it for. We're just simply taking what we actually paid for it, and in small chunks it's expensing it instead of doing it all up front, because it's going to help us for several years. Okay, so let's further our example with the $25,000 piece of equipment that's going to help us generate or help us make dry erase markers that we're going to sell. So we started out with $100,000 of cash and $100,000 of capital stock. So as we purchased $25,000 of equipment, so equipment's going up with a debit, cash is going to go down with a credit. That makes sense to us. Now it's going to last us for 5 years. We're going to have to uphold the matching principle, which says to put expenses in the same period with the years that they help generate revenue. This piece of equipment isn't going to only last us 1 year, it's going to help us make these markers to sell for 5 years. It's going to help us generate revenue for 5 years, so we need to make sure that the expenses are recorded over that same 5-year useful life. Okay? So the $25,000 divided by 5 gives us $5,000. $5,000 a year, 1/5, is going to be recorded as depreciation expense every year. Okay, so this is an expense. It's increased with a debit, and we're going to. It might make sense to you for us to put the $5,000 over here, but that's not what we do. We instead would put the $5,000 in this accumulated depreciation account. Okay? The fixed asset account, in this case equipment, is not decreased when making the related adjusting entry, this entry that we're talking about right now with depreciation expense. This is because both the original cost of a fixed asset must and the depreciation that is accumulated must be reported on the balance sheet. Instead, a contra account entitled accumulated depreciation is going to be increased with a credit. So accumulated depreciation is a contra asset account. So an asset's increased with a debit, so this is increased with a credit. And what's going to happen every single year, we're going to make the same entry, a debit to depreciation expense and a credit to accumulated depreciation. We're going to do this at the end of the accounting period. We're going to do it over and over and over again. So after 5 years, we would have accumulated $25,000 of accumulated depreciation, and that combined with this equipment here, when we look at what the asset is and its associated accumulated depreciation, the difference between those two we call the book value. So right now the book value would be 0, right? Because we've fully depreciated it. After only year 4, the book value would be $5,000. We have $5,000 undepreciated cost here, right? But after that 5th year, we have a book value of 0. So the reason that we do not, it might make sense to you to say, oh, well, we should have just been putting the 5,000s up top here. Well, the reason that we do not do that is because 25,000 and 25,000, this has a balance of 0 right now. That means that when we prepare the trial balance, if the account has a $0 balance, we probably wouldn't even list it. Now think about that. If somebody came through our factory and saw this $25,000 piece of equipment on the floor, then they might wonder, why isn't it not showing up, or why is it not showing up in your financial statements? And we wouldn't have an answer other than we didn't understand how to handle the depreciation, because this needs to be in a separate account, right? Now, just because it's fully depreciated, meaning we have systematically each year taken, and by the way, we would have been recording depreciation expense too, right? Every year we took 1/5 of this away. It could have had a useful life of 10 years. In this case, in this example, we happen to use 5. But just because something's fully depreciated does not mean that we have to quit using it or remove it from the books. After this 5th year, even if this piece of equipment is still working fine, we're going to leave it in our accounting records. It's going to have a book value of 0. We would see these guys listed in the financial statements right beside each other. It'll say equipment, and then below it, it'll show accumulated depreciation. So the asset and the contra asset are always going to be shown together in the financial statements. They're always together like Bert and Ernie, Sonny and Cher, peanut butter and jelly. You know, the list goes on. But they're always shown together. And like I said, the beauty of this is that we are able to show this at its historic cost. Remember the historic cost principle. We have to show it at that. And if we credited the equipment account here, then that would mess that up. Okay, so that's why we have to use this separate account called a contra asset account. Now, once we've fully depreciated this, we can still keep using it like I said a second ago, but once we get to the point in time that we are no longer going to use it, maybe it breaks down and it's not even worth fixing it, we're going to drag it out in the yard and let the grass grow around it, or drag it out in the woods behind the factory, or scrap it, or do whatever, at that point we will remove it from the financial statements. And we'll talk in a later chapter about handle the accounting for that, but for right now that's basically what you need to know. So let me go back and bring this down. So we started out with $100,000. We purchased the equipment, so cash went down, the equipment went up, and then every year we're going to make the same entry. Depreciation expense is going to be debited, accumulated depreciation is going to be credited. At this point in the game, they're always going to feed this number to us. They're going to tell us what the depreciation expense number is. Later on in the course, we're going to learn how to calculate this number, but for now, this is really all you need to know about depreciation. Thank you. Please let me know if you have any questions.